January 1, 2005 The Real Estate Capital Scoreboard January 2005. Last year proved to be one of the best times in modern history to tap into the real estate capital markets, both for selling and financing assets. Debt costs were among the lowest in nearly 40 years. Treasury bills almost as much as 0.75%, finally settling at levels nearly identical to the day's rate for 10-year terms and increasing about 0.5% for 5-year terms. Meanwhile, LIBOR continued climbing throughout the year, increasing by 150 basis points, but still remaining at extremely attractive levels. While treasuries bounced, mortgage spreads steadily dropped by as much as 25 basis points for conventional property types, and more than 75 basis points for higher risk and specialty properties. Lower leverage financings attracted funds within the 75 to 100 basis point range. The net effect translates to nearly the same permanent rate ranges for 10-year loans and about 0.25% higher for 5-year debt. As short-term rates continue climbing, long-term permanent mortgages are the best buy in the marketplace. Loan spreads remain tight as lenders aggressively seek new funding opportunities, and 2005 should be a record year for lender production output based on capital availability. February 1, 2005 The Real Estate Capital Scoreboard February 2005. Short-term rates continue climbing with 5-year rates moving up by about 10 basis points. Long-term mortgage are nearly unchanged from last month. Long-term treasuries remain steady as bond investors have limited alternatives. Lenders continue widening spreads, although margins are already at rock-bottom levels. Alternatively, many lenders compete by offering more aggressive underwriting, including looser debt service coverage restrictions and higher leverage. 80% loan-to-value ratios are commonplace, 90% is readily available with mezzanine-level programs. The Fed's quarter-point increase was widely anticipated. The market is expecting additional steady rate increases throughout the year. Short-term LIBOR and prime show direct increases as the yield curves continues to converge. Capitalization rates and overall equity yields mount under continued pressure. No price relief in sight. March 1, 2005 The Real Estate Capital Scoreboard March 2005. Mortgage rates increased by 25 basis points or more during the past month for fixed-rate deals. Bank prime and LIBOR also increased by more than 20 basis points. However, mortgage spreads remain consistent at levels of 100 to 150 basis points over comparable term treasuries. Also, no substantial differences are noted in the realty equity markets. Since the Fed began boosting short-term rates in June, long-term interest rates steadily declined. The flattening of the yield curve illustrates that international demand for U.S. Treasuries is overshadowing domestic short-term rate concerns. April 1, 2005 The Real Estate Capital Scoreboard April 2005. With the exception of LIBOR, this increased about 0.25 point. Longer-term Treasury notes dropped by nearly the same amount, indicating a flattening yield curve. Lending activity remains brisk. Equity markets regularly report capitalization rates below 7% for prime properties. Return on cost, developers' yield, continues to drop. More higher quality, traditional property types are constructed with developer yields below 8.5%. Given such attractive market conditions, built-to-suit and speculative development should continue unabated. Mortgage spreads are historically tight, as has been noted throughout the past year. Pressure for lower yields is evident as investors flock to a greater variety of property types in search of more yield.
May 1, 2005. The Real Estate Capital Scoreboard. May 2005. The yield curve continues to flatten even more. The Fed raised rates for the eighth consecutive time by 0.25% at levels nearly identical to January 2004. During the past month, longer-term rates decreased by more than 30 basis points, while short-term indices increased by nearly 0.25%. Bank prime is similar to levels not seen since fall 2001. New construction financing options are more important as capital sources are moving sooner into the funding curve to capture a transaction. In some cases, lenders and investors are funding entitlement costs as part of the capital structure. Rising construction costs, including renovation and tenant improvements, are among the more important issues of negotiation as inflation creeps into material and labor costs. Controllable versus non-controllable costs are explored as developers and capital sources attempt to mitigate rising construction budgets. Equity markets still reflect strong product demand. As interest rates continue climbing, capitalization rates are expected to lag by about 40 to 50 basis points. June 1, 2005. The Real Estate Capital Scoreboard. June 2005. June 2005. Despite dire warnings about property and housing bubbles, the U.S. debt and equity real estate capital markets briskly move forward. Undaunted by lower yields, investors flock to bricks and mortar transactions in contrast to paper profits offered by stocks. The result leads to mortgage spreads further compressing over treasuries. Said another way, conventional income property types, for example apartments, and higher yield property types with greater risk, for example hotels, are priced as close as 25 basis points or less. Such spreads signal peaking market conditions. As debt markets are flooded with liquidity, highly competitive lenders use debt service coverage as a key underwriting variable, overtaking the traditional importance of the loan-to-value ratio. This underwriting format is justified as record-high property prices drive capitalization rates barely above mortgage rates, in some cases, 50 to 100 basis points. In fact, longer-term loans are frequently underwritten as interest-only for the entire term.
July 1, 2005. The Real Estate Capital Scoreboard. July 2005. As has been the case since the beginning of the second quarter, the yield curve continues flattening as various term debt instruments converge. 30-day LIBOR is within 100 basis points of the 10-year Treasury. Under many circumstances, borrowers are re-evaluating their floating rate obligations in favor of switching to fixed-rate debt. For the most part, the best pricing for permanent loans is within the 100 to 150 basis point range, with exceptional properties and low-leverage ventures dipping below 90 basis points. No substantial change in the equity markets, although multifamily assets are difficult to price on the capitalization rate basis as condominium converters and developers size these ventures on a for-sale model. August 1, 2005 The Real Estate Capital Scoreboard August 2005. U.S. Treasuries moved higher during July as Fed announced the 10th straight rate hike. Yet, mortgage rates remained unchanged from the previous month, at historically low levels. The yield curve is in the spotlight, flattening as investors bet that the narrowing difference between short and long-term bonds will continue. Although most multifamily markets are in a tight supply and demand balance, some construction lenders are tightening funding parameters as statistics and media attention are drawn to the potential housing bubble. As an example, equity requirements are being set at a minimum level of 20% based on total project costs. September 1, 2005 The Real Estate Capital Scoreboard September 2005. Treasuries bounced throughout August, fluctuating as much as 40 basis points. Even after the Fed raised rates for the 10th consecutive instance, rates finally settled about 0.25% lower. Meanwhile, the yield curve remains flat as long-term bond buyers have limited investment options and inflation fears are under control. Since spreads are extremely thin, lenders are offering a list of features to remain competitive. 1. Interest-only payment format during the first 2 years of the loan term. 2. Float-to-fixed conversion options. 3. Minimal carve-outs guarantees. 4. Lower fees and closing costs. 5. Reduced forward delivery premiums and 6. Waiving recourse on construction loans. Virtually no pricing differences exist between various lenders including banks, life companies and securitized lenders. Generally speaking, life companies offer the most competitive structures on forward delivery loans and prepayment provisions. Banks reign with construction lending programs and securitized lenders offer highly structured programs based on maximum leverage.
October 1, 2005 The Real Estate Capital Scoreboard October 2005. Comparable term treasuries versus mortgage rates are at the lowest levels of recent history. Debt markets lack any room for additional pricing concessions. Lenders continue expanding property types and fine-tuning loan programs with extra borrower for benefits. Bidding wars are common across nearly all capital funding structures. The Fed's 11th consecutive quarter-point increase had a proportional impact on treasuries and LIBOR. Most long-term treasuries and LIBOR climbed about a quarter point as well. The yield curve remains nearly flat, as the spread between LIBOR and 5-year treasuries stays relatively constant. Borrowers fearing additional rate hikes in the face of Fed warnings are opting for forward delivery mortgages. Mostly offered by portfolio lenders, such as debt is available up to 18 months. Pricing premiums start at 3 to 5 basis point range per month after the first 90 days. November 1, 2005 The Real Estate Capital Scoreboard-November, 2005. The Fed's 12th consecutive quarter-point increase places Treasury yields at their highest levels since March. Rates continue climbing as rising energy costs filter into the economy. More policy changes are underway. The new Fed chairman's priority is inflation control. Regulation of residential mortgage banking industry is a favored method of curbing consumer mortgage debt overload, instead of simply raising rates. Overall actions will eventually widen Treasury spreads for commercial property loans and more regulation is expected. As has been true for much of the market since the summer, the yield curve remains flat. Only a 10 basis point differential separates 5 and 10-year debt. Long-term rates are extremely favorable as compared to floating rate debt, with spreads starting at 90 basis points over comparable term treasuries.
December 1, 2005 The Real Estate Capital Scoreboard-December, 2005. Equity markets are extremely competitive. High prices persist for all property types, as replacement costs become more important variables. Material and labor shortages across the country are sure that existing product pricing premiums are maintained. The good news is virtually no news, as overall mortgage spreads remain at record low levels. Few alternative yield options are available to Wall Street.